Bombay. So I hope there is no coordination issues. I hope all of you have got the investor presentation, the press release. I think most of the items are self-explanatory, so I won't want to take time explaining what is anyway put down on all these documents. So happy to go straight into the questions.
Should we open the floor for questions, sir?
Yes.
Yeah. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Renish Bua from ICICI Securities. Please go ahead.
Hi, sir. Congrats on great set of numbers.
Okay.
Yes, sir. First question is on core fee income. So on annual basis, we reported pretty strong growth of 30% YOY to almost 220 crore.
Right.
Which is 165 crore last year.
Right.
Sir, can you please throw some light on what is the incremental core fee drivers?
So it is the same explanation that we have been giving in our earlier calls.
Mm-hmm.
So we have a set of products in our bank assurance cross-sell, like health insurance, MRTA, life insurance. We have mutual fund sales. Mm-hmm. We have done a lot of training across the branches for the front line on FX. We've added a couple of FX products, again on a totally retail. Mm-hmm. Then we have also done a lot of work on the retail and SME space on trade. Mm-hmm. So as we keep acquiring new customers and also keep training people in the front line, we are able to do cross-sell. The other income that has done well for us is that we have done a lot of rationalization on ATMs. Okay. Wherever we found ATMs are not working well, we have shifted, closed, those kind of things. So that has brought in some efficiency on ATM revenue.
Right.
And in overall fees, of course, like last year we have earned, that doesn't come in commission brokerage, but on an overall basis we have also earned a sale of PSLC certificates. So I would say that, based on the work that we are doing in all the products, I expect our fee income to do well. But again, I want to see one more year, a few more quarters before we can declare full victory on progress on fee income.
Right. So, sir, basically going forward, so it is fair to assume that the fee income growth will be a little lower than the current year, but will be in line with the balance sheet growth?
I'm not sure I can give you that kind of position. What I can tell you is that the way the products have been rolled out, the training has been done. I mean, one of the data point I can tell you is that I believe that we have something like more than 1,000 people trained in cross-sell of bank insurance, certified. Even some of the larger banks may not have that many because they're very disciplined that only if you are certified you can sell these kind of products. Okay. So the groundwork is happening, and again, it's a daily, weekly, monthly affair in terms of monitoring your sales team, making sure that they are doing the right thing, managing productivity and so on. I hope we keep doing well on fees. That's all I can tell you.
Yeah. So basically we have started doing this, aggressively cross-selling in current year, or it is like exercise we were doing in past couple of years and that is, that started yielding positive results just now?
I think I have mentioned even in the past that we are continuing to do a lot of good work on the ground. It takes time to come through. So I do think that once I see another 3-4 quarters, we can confidently say that there is a reasonable amount of momentum in fee income.
Okay. Yeah. Thanks a lot, sir. And sir, second question on the deposit side. So we have seen pretty sharp surge in deposit on QOQ basis. So our bulk deposit share has also gone up. So is there any, chunky deposit which we have, received this quarter, or it's like a year-end thing, normal year-end thing?
So, if you have seen our balance sheet in detail, we have taken a lot of Tier 2 capital last year. I think it's about 500 crores, 450 odd crores, yeah. Then we got some relief because of change in SLR.
Right.
We got refinanced from SIDBI, NABARD, and we didn't have to really do that much of deposits in the first few months. Right? And what we believe is that the amount of work that we are doing and the spread of our branches, we should do a lot better job on retail deposits, especially retail term deposits. We have good products there. We have a product called Suraksha, where you get automatic life insurance, but it's a longer-term product which supports our mortgage growth. That is showing some traction. So I do think that we will do better on retail term deposits in the coming year.
Okay. And so last question on the CD ratio. So do you think this CD ratio is picked out at current level, or there is some more scope for further improvement?
So anywhere from, as long as the other ratios are in check, the kind of ratio that we are looking at is saying we want to consistently bring down our top 20 depositors. But I must tell you that our top 20 loan is below 7%.
Right.
So our loan book is very granular, extremely granular loan book. And I think that our loan book would be, while I don't have the exact number, but more than 70% of our loan book would be less than 3 crores in terms of ticket size. It's pretty granular kind of loan book. But on deposits, I would say that our efforts are still on in terms of making it more and more granular, especially in the term deposits. And CD ratio, I would say that as long as it is between 80-82%, year-end is always a little higher, but during the year it does come down.
Okay. Yeah. So, thank you so much, sir. That's it from my side.
Thank you. The next question is on the line of Anuj Gupta from Perfect Research. Please go ahead.
You are not audible. There is some disturbance behind you. Hello?
Yeah.
Yeah, okay. Am I audible now, sir?
Yeah, better.
Yes. So I just wanted to know what is the long-term ROE which we can achieve and maintain given our growth aspirations?
I wish I could tell you a lot of things on a long-term basis. All I can comment at the moment is that based on what we put out on October 15, we are trying to work very hard to reach 1% ROA, about 14% ROE, and exit quarters 55% cost income ratio. Once we see that we are reaching that particular stage, and work is on, and you can see that there is a lot of momentum that we have been able to build. There is one more data point I'll tell you once I finish this answer. So I think long term, of course, we want to be at 17-18%, but at the moment I'm targeting, let's get the ROE at the place that we mentioned in our October 15 press release. And once we reach that, I think we'll be able to give you more sense on what kind of ROE we can do more than that. And with respect to loans, last few years, I would say that little bit of loan book also came from some of the bought-out portfolio, some NBFC bought-out portfolio, etc. This year, I think we probably didn't have any bought-out portfolio. So therefore, whatever we had bought out would have been declining only. It would have been a declining balance. So if I eliminate the bought-out portfolio from both years, the growth rate actually, the organic growth rate actually seems to be almost 30 or 31%. So I would say that if we continue to perform like that, we should see our cost income ratio come down and similarly reflect on both ROA and ROE.
And so the other is, what is our current market share in the SME space and the addressable size of opportunity for us in the same?
What is the first part of your question?
So what is the current market share in SME space?
So I wish there was a clear definition amongst all banks in terms of what exactly is SME. Some banks say that they are in SME business, but their average ticket size is 5 crores. We are in SME business and our average ticket size is 40-50 lakhs. Okay, so I don't know exactly how to calculate the market share in the segment that we are operating in. But what I can say is that SME that we have put out, for example, what you see as about, I think, 12% of our book showed a very good performance. I think almost a 30% growth in the previous year. And size addressable market, we believe it's in our presentation as well. I believe that there are at least 50 million small and medium-sized enterprises who we can target. And we have a very minuscule number of, although we are growing well, but we have minuscule number of customers in that, and the market is still very big for us to grow. And that is our stated strategy. We are an MSME bank. We like only that segment. We don't go after salaries.
Yes. Thanks a lot, sir.
Thank you. The next question is from the line of Ashish Sharma from Enam Asset Management. Please go ahead.
Yeah, hi. Great set of numbers, sir, and thanks for the opportunity. Just on your loan book growth, if you see the FY18 numbers, March 18 numbers, we've seen a very strong growth in the corporate banking space and also in commercial vehicle. Just some color on as to, do you see this kind of traction in both these segments will continue? Just one question is that, and second would be an outlook on net interest margin. We have seen, despite a cautious stance from the management, net interest margin has been resilient. So do you expect this trend to sustain? And just lastly, one data point, what is the employee number as on March 18?
So employee number, Bharat, I don't have the sheet here. It's about 5,800. What is the number?
It is 5790.
5790. Thank you, sir.
So that's our employee number. And regarding NIM, we are always conservative in our approach on NIM. We have seen tremendous amount of pressure on NIM in the last quarter of some banks that I would not have expected them to be so aggressive on. Of course, some of the banks have pricing power. Our cost of fund is still 6.5% of cost of fund, whereas others may have lower cost of fund. So I do see a lot of pressure on that. So I would continue to be very cautious about giving any indication about NIM. With respect to corporate bank, I have always maintained that corporate bank will be approximately 15 to 20% of our book. We have no intention of growing that aggressively or anything. But some good things have happened. We never increased our capacity or headcount or anything else in corporate bank. But as you know, the situation in banking industry, some of the public sector banks are in difficult situation. So that has opened up opportunity for us to target some really high quality corporate. We have used that opportunity. Again, we have done small ticket kind of loan. When we say small ticket means by corporate standard, like something like 20, 25 crore, 30 crore, that type of loan, and very safe kind of loan. We don't have any intention to change the product mix. Even when we double our book, I still think that corporate banking would remain at about 15 to 20% of our book. With respect to commercial vehicle is an area of focus for us. We are doing quite well. It is now up to 6% of our total loan book. 70-80% of the loan book is priority sector lending, so that helps us in many ways, including getting some additional fees on PSL certificates. And I do expect commercial vehicles to be an important part of our portfolio as we go forward.
Okay. Perfect, sir. Sir, it would be great if you could just share the yield on the business across, from a segment point of view.
We are only sharing overall yield. We are not able to share with you the individual yield. And again, in each business, supposing we take commercial vehicles, there are so many segments of what yield can I give you on that. Similarly in mortgages, similarly in gold loans, all depends on
but the breakup between retail and non-retail yields would even be helpful.
No, we are able to give you only the overall yield and that we have consistently given over a period of time.
Yeah, that's helpful, sir. Perfect, sir. Thank you, and all the best for the next quarter, sir.
Thank you.
Thank you. The next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Sir, will you update, so many PSU banks have a fund stuck in NPA. So demand is more as far as DCB Bank is concerned? Loan demand is more?
Bharat, can you repeat that question for me? I'm not able to, because there's some echo.
Due to PSU Bank funds stuck in the NPA,
Yes.
demand is more from DCB Bank for advances?
I don't know what is driving what. We have added, in fact, we have almost doubled our branch network. We have added a lot of capacity of sales. The headcount has gone up. And there is a big addressable market. Like I mentioned in the previous question, almost 50 million self-employed SME, MSME target market is available. We have wide range of products from commercial vehicle to gold loan to SME to loan against property. We can do all those products. So I do believe that the way we are driving the sales and the way we are building up capacity is helping us to acquire new customers and increase our loan book. Additionally, of course, I do see that there is some level of problem that is there in many of the public sector banks. That is also giving us some more, opportunity. There is no doubt about it. But I don't know exactly how much is that opportunity. Not able to quantify that. In corporate bank, definitely we have seen some loans move to us, primarily because some of these large customers don't believe that they will be supported in the near term by some of these banks. So therefore, it has given us an opportunity. But SME, MSME, very hard to say exactly what part is moving to private banks.
Thank you. The next question is from the line of Jai Mundra from BNK Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, the first question is on your mortgage book, which the share has come down to 40% now. Earlier, 2 years back it was at the high of 45%. So, do you see any trend there, or do you see it would more or less be similar share?
No, I mean, it is still a very dominant business for us, will continue to be a dominant business for us. After demonetization and GST, we changed some of our credit policies and backed off from some of the segments, that is sub-segments of SME that we were operating in, because we felt that they are not adjusting well to the new change situation. So that has cut out some part of our new sales. Second thing is that there is a huge amount of competitive action. There is a lot of pricing pressure on mortgages. So we probably lose more loans out of our book now because of prepayment than we were losing last year. But having said that, I still think mortgage will be a very large part of our book. It will be in the 35-45% kind of range. Quarter to quarter, it may change a bit here and there.
Sure. So, and you touched upon the competition part. So, sir, can you kind of throw some light on the repayment, let's say, rates which were, let's say, there 1 year back or 2 years back, and what rate is it now? So, roughly, I mean, a broad number will also do.
We don't give that kind of details, and it's very hard to say. In the fourth quarter could have been the new sales also was very high, and some of the prepayment foreclosure also was very high. But I'm not sure that would continue in the first quarter. But having said that, I would say easily the foreclosure situation has gone up by 30-40% as compared to, say, the previous year. So competition is very tough, and we have tried to be rational about this. There are times when we see that the valuation of the property or the amount of money that should be given to the customer is more than what our credit appetite would allow us to do. So we have let go of those kind of loans. So we are operating within the credit appetite that we have defined for ourselves. So that's the way it is.
Sure. And so just lastly, what would be the broad breakup of, LAP and the pure mortgage with this 40% share?
You mean difference between the breakup between LAP and home loans?
Yes, sir.
70-75% would be loan against property, and about 30 odd would be home loans. But let me explain to you, we deal with self-employed customers, small customers. They hardly make, from their point of view, they don't see any difference between home loan and loan against property. Because over, let's say, 2 or 3 years after the home loan has been repaid, they do come for some top-up, and that switches to from home loan to loan against property. It may have started as home loan but becomes loan against property, right?
Yes, sir. Sure, sir. Thank you, sir.
Roughly 70-75% would be what I would say is our loan against property.
Sure. Thank you, sir.
Thank you. The next question is from the line of Sagar Shah from KSS Shares and Securities. Please go ahead.
Good evening, sir.
Good evening.
First of all, congratulations for such an excellent performance.
Thank you.
My first question was regarding the cost of funds, sir.
Yeah.
Cost of funds has seen a drastic downturn, that is 6.51%. Mm-hmm. That is actually very good as compared to, if you compare to the previous quarters actually. So, any reason for the same, sir?
So let me just take out the cost of fund slide because I want to make sure that we both are referring to the same number. The 6.51 that you see is a full year number. Bharat, that's correct, right?
Yes. As compared to the last years, it is quite less, yes.
Right, but I think it is slightly up if I see compared to the previous quarter. Bharat, just help me with that for a minute.
Previous quarter sequential was 6.42.
Yeah. So actually we have seen an increase in cost of funds from the previous quarter.
Yes.
The interest rate as well as the liquidity was tight. So obviously the term deposits, especially the large ticket term deposits that was priced higher in order to attract. It was unbelievable that some of the deals that we were losing was to large banks, and I never thought that large banks would outprice us in deposit, but it happened. But I think situation is somewhat stable now, and we hope to maintain the cost of funds at this level, do well on CASA, and hopefully not sacrifice too much of NIM.
Yeah, sure, sir. Yeah, my second question was regarding to something like, as we can see, the 40% of the book is from mortgage. So something like what my question was that something like in the future, and maybe FY19 or FY20, are we looking to diversify that loan book into more into consumer loans, maybe the consumer finance?
Mortgage is a total consumer loan.
Okay.
The average ticket size is 35 lakh. I can very safely say in banking, we will be one of the most granular, pure retail SME banking.
Okay.
70%, I believe, of our loan book is 3 crores and below.
Yes.
When I look at our gross NPA of 360 or 370 crores, if I remove the top 5 accounts, the balance, say, 300 odd crores of NPA would be contributed by about 200-300 accounts. That is how granular it is in our NPA also. That is why we have a lot of confidence in terms of when it is secured, in the sense it is backed by self-occupied property, which is either commercial or residential. So therefore, our leverage in terms of recovery also, we have confidence.
Okay. Sir, actually,
so mortgage, don't say it's not, it is consumer loan and it is business loan.
Okay. Sir, actually, I was pointing to the consumer loans for something like for the two-wheeler loans, something like if a consumer...
We are not in two-wheeler business.
Okay.
Only for existing customers from a branch, we offer two-wheelers. Similar to auto loans, we also don't go for car loans in an aggressive manner because we don't believe that it is value-adding. But however, if a customer comes to our branch, we would happily give them a car loan. But other than those two loans, which we don't have for those two loans, we don't have a separate sales team. But other loans, we have separate sales teams who will go and get these business.
Okay, sure, sir. And the last question was regarding to the branch expansion, actually. something like in the FY19 and also in FY20, how many branches are you basically targeting to open, something like?
Okay, so we are at 318 branches right now. So in the coming year, that is 18-19, we expect the branch to be increased by about 15 or 16 odd branches. Similarly, the following year, that is 19-20, we expect to do about 15 or 17 branches. Supposing our cost-income ratio was 50% or 48%, we would be very confident about adding more branches. But first, we want to fix the metrics before we embark on any expansion if necessary.
Okay. Yes, and my sir, just to actually, I got a reminder. One last question was regarding to the end-to-end losses, something like in our trading, maybe in the trading investment portfolio. As the latest RBI circular has pointed that the amortization loss cases can be.
I don't think we have amortized anything.
Okay.
I don't think our loss was. Bharat or Rajesh can throw some light on it, but I'm very confident that I don't think we have done any amortization. Bharat, you can answer that.
So we have not amortized any losses.
Okay, you're not amortized losses. No. Okay, yeah. Sure, sir. Yeah. All the best for the future, sir.
Okay.
Thank you. The next question from the line of Drashti Shah from Investec Capital Services. Please go ahead. Drashti Shah, your line is unmuted. Please go ahead. Seems there's no response. We'll move to the next question. It is on the line of Alok Shah from Centrum Broking. Please go ahead.
Thanks for the opportunity. So congrats on good set of numbers. I had two questions to understand from you. One is I was looking at operating expenses per branch, and that seems to be stabilizing somewhere around 6.5 million. And when I try and look at this in context of revenue per branch, the profitability has been on rise. How are we looking at this number? So just trying to look at the break-even point, I think, and we've moved beyond that line item.
Yeah. Bharat, can you just repeat the question because I just couldn't get anything of it.
Only Alok mentioned that our operating expenses per branch seems to stabilize at around 65 lakhs.
Okay.
And in context of the revenues that we are generating, how does it relate vis-a-vis break-even point? Am I right, Alok?
Yeah, that's right, sir, because I'm looking at it.
Okay. So the answer to that is we have about 60 odd lakhs as the average cost per branch, especially the new branches. Some branches could be even 1 crore of rupees, depends upon the location. Some could be 45 lakh rupees. Okay. And you can see in our investor presentation the distribution of branches, 20 odd % in rural, another 20 odd % in semi-urban, etc. Okay. Now, the way we put our business model is that assuming you have a 3.5-4% NIM, right? If you get a book of, say, about 15 crores, when I say book means assets, liabilities, both put together, okay? And you make a 4%, say, margin, you already have achieved break-even. Correct?
Sure.
Are you with me?
Yeah, I'm there, sir. In a sense that if I look at this long-term average profit per branch between...
So long-term and all, we cannot tell you. We have told you how we are looking at up to 2019. I mean, what is long-term? For you, long-term could be 10 years. For me, long-term could be 3 years. I don't know what is long-term. But all I'm trying to tell you is, the way we are looking at it is, in 18 to 22 months, if we are able to achieve break-even and sustain the momentum, by 36-42 months, we will be able to achieve 50-55% cost-income ratio on a particular branch. And most of our branches, barring maybe 10, 12, 15 branches, are tracking to that, are tracking to the trajectory.
Sure. That's
right. So, and that is how we have been operating for the last 2 years. That is what we explained when we set out on this initiative of putting 150 branches. Each of these branches is being tracked on a daily, monthly basis to make sure that none of them miss out on that. Of course, it's not possible to ensure all of them do well, but some branches have broken even in about 8-9 months also.
Sure. Yeah.
The other thing I want to tell you is that if you look at our CASA per branch, I think it is about 17 crores, if I'm not mistaken. and we are at about 5,800 odd crores with about 318 branches. So our intention is that how do we take this CASA to a 25-27 crore per branch? Okay? That's what we are trying to do. The third thing that we are trying to do is, if you look at our business per employee, it is at 7.66. We are quite, we have a lot of respect for City Union Bank. I think they are at about 13 or 12. So we think that what is the time period it will take for us to reach that level of business per employee. So these are the things that we are pursuing at the moment.
Yeah, that's helpful, sir. My second question to you is more on the NPAs that we have seen in pockets of gold loans and CV. Anything more to look into it, especially the CV portfolio of 30 odd crores of NPA?
Yeah,
what will be the nature of these NPAs?
CV portfolio NPA has got to do with things that industry had to deal with. I think in terms of some of the changes that was brought about in that industry, that is in the CV industry. Then during GST, I think there was a lull in business. But from any issue from a portfolio point of view, whatever analytics we have done, we don't seem to have any. We don't seem to have any issue. We think that these are all recoverable kind of NPAs. Regarding gold, it sometimes can be seasonal. We have pretty strong controls to make sure that there is no operational loss on gold or any fraud in terms of gold. So these NPAs all will come back.
Sure, sir. That's helpful. Thank you and wishing you all the best.
Thank you. The next question is on the line of Ritika Garg from Equitas Investments. Please go ahead.
Good afternoon, sir. So our cost-income ratio has improved to 59.79%. So what's our target and when do we expect to achieve it by?
I want to achieve it as soon as possible. But the target at the moment we are pursuing is fourth quarter of 2019. We want to see how to achieve exit of 55%.
55%.
Yeah, in the fourth quarter of, not for the full year, but on the fourth quarter of 2018-19. Now, beyond that, long term, we want to be below 50% on cost-income ratio. Still a lot of hard work ahead of us, but we are confident that systematically we will reach there.
Okay, sir. Thank you.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Trustee Shah from Investec Capital Services. Please go ahead.
Hi, sir. Thank you. This is Karthik from Investec. Two questions. So we've seen an increase to our restructured book on a sequential basis.
Increase in restructured book?
Yes.
No. How?
I will take that.
Yeah.
We had a restructured NPA account, 9 crores, which moved up to restructured standard.
Right.
That is one of the prime reasons for increase in restructured standard book.
Okay, so it finished its moratorium and you had to upgrade it.
Yes. It doesn't become standard till 1 year performance. I mean, after standard, it doesn't move out of NPA or restructured pool till it performs for 1 year. So as per IRAC norms, at this point of time, it's moved from restructured NPA to restructured standard.
Okay, got it, sir.
So let me explain that also further. There was an account which is a LRD account of a good customer. One of his tenants vacated. He was not, because of the market conditions, he was not able to, pay. Basically, out of the 3 properties, he was able to pay rent only for 2 properties. We restructured the loan, I think, in December 2016, if I'm not mistaken. This was immediately after the demonetization. Then, for 12 months, he has consistently paid his loan. I think, and technically, it has now come as restructured standard for us. Is that what you're saying?
Yes.
Yeah. So that is what it's still a very good account. I'm very confident about this account.
Okay, sir. Our tax rate for the quarter has been quite high. Any particular reason?
Murli, shall I answer that?
Yeah, please.
We had a 2 crore one-off expense which was there in tax line. Otherwise, effective tax rate is in line with rest of the quarters.
Got it. And the reason why I was asking is our PBT growth is 26. It's come down to 21% at the PAT level. So primary culprit here seems to be the tax numbers.
Yeah, 2 crores one-off cost.
Got it. And the security receipts outstanding?
Security receipts outstanding will be 2 crores. 62 crores it is.
Okay.
In fact, it is, I think, among the few banks, we are among maybe the only or few banks for whom security receipts are getting redeemed with the underlying assets realized.
Got it, sir. And so as we move into the new regulatory regime in terms of the RBI resolution plan, do you foresee any major adjustments to the business model or potential accounting impact?
What is the question?
The Fed circular I was referring to. The Fed circular, sir. Do you foresee any potential impact in terms of accounting?
Are you talking about the circular latest, the February circular?
Correct. Yes, sir.
The February circular, I think, says that in terms of the NCLT account, we have to provide 40 or 50% or IRAC norms as the case may be. Correct?
Correct.
Yeah, so we have very limited impact, and in fact, from whatever last 5 years that I know of, our provisions have always been higher than IRAC norms. Okay, so I don't think we should have any impact on that.
Got it. And finally, our quarterly gross slippages number do not add up to our full year number. Any particular reason?
Gross slippage is not adding up to full year number.
Yes.
Quarterly gross slippage number you are saying does not add up to full year number?
Yes.
Okay, let me check and come back to you. We'll get back in later part of the call. Yeah?
Sure, sir. Okay, no problem. And if I may squeeze in one last bit.
Yes.
So if I look at your general guidance for cost-to-income ratio, you've chosen the Q4 quarter, which is typically a pretty strong quarter from an income perspective. And so even from a seasonal perspective, Q4 usually has the lowest cost-to-income within the year.
Right.
Could you help us understand maybe how the expense growth for the year would be?
So Q4 is always a very good quarter from income point of view and Q1 is always a very difficult because in Q1 the salary increase of employees comes in and hits you, right? So that is how it has been, I think, for many years and perhaps in the entire banking industry. Our outlook on cost-income ratio is like this. We are trying to achieve in the exit quarter of 2018-19 a 55% kind of cost-income ratio, right? And it is based on the productivity and the hard work that is being put, which you can see in terms of our loan growth. Our loan growth is 29%, which is pretty good from my point of view. Right? So this is based on employee productivity, utilizing the capacity of the branches. That is what would help us to reduce our cost-income ratio. Beyond 18-19, our idea is putting up a path to achieve below 50%. But when we are going to do that, I am not able to tell you right now.
Yes, but I was actually suggesting what would in your mind be the expense growth number for FY19 when you are arriving at this 55%?
No, we don't give such specific numbers. All I am saying is, like for example, supposing we are thinking of adding 200 staff, as we will give you an example. But as the opportunity comes up in some business, I may add 100 more staff. So I don't know exactly what would be. There is a budget process in the board. We would give the budget to the board. The board will deliberate on the budget, give some challenges to us. We agree and then we start tracking ourselves to that budget. That's the way currently the process is working.
Only just 1 minute. Karthik, could you tell me which number you are not able to tally? Because I can't find any inconsistency.
Okay, so when I actually look at the full year disclosures on the slippages number.
Correct. Which number you are looking at when you say full year slippages number?
3,4. I was looking at 3,463.
Okay. So 3,463.
This is the sum of so 3,463 is the fresh slippages.
Yeah.
The addition to existing NPAs is 26.
Sorry.
And there is also an addition to existing NPAs of 26 million for FY18.
Correct.
So that number, when we add on a quarterly basis for all the earlier quarters, adds up to 3,511.
I doubt it. If you could read out the 4-quarter numbers which you are looking at.
Yes, sir. So let me start with...
I'll just read out the number. I'll just say that I have double-checked, and Q1 to Q4 current year,
yes.
Fresh slippages with fresh slippages 3,463, and addition to existing NPAs adding up to 26 is the right number. I reconfirm. If you have differences, you can come up to me and we can offline tally it for you.
Got it, sir. Okay.
Okay, operator, we have time for 3 more questions.
Sure, sir. Yes. The next question is from the line of Paresh Jain from Bajaj Allianz. Please go ahead.
Yeah. So just wanted to understand that on the CV side, is it largely new fleet that we usually finance, or is it second hand? Are these fleet owners, or are these single truck drivers and all?
So we are very, very light on strategic business, that is large ticket. So we are more on SME segment, small ticket, like 3, 5, 10 trucks kind of small ticket. So that is largely our business, FTB, FTU, that kind of business.
Okay.
And 70-80% of this business is falls under priority sector lending.
70-80% of the business? Yeah. And these are what, largely new fleet?
No, it can be refinance also.
Okay. So what was the average?
Refinance as well.
Okay. So what was the average age like?
Average what? Average
age of the fleet that you would have financed?
I don't have that data, Paresh. But all I'm saying is that I think maybe 20% of our loan book could be on refinance. And the same customer could have a new as well as refinance. You know, there could be combinations like that depending upon the customer quality.
Okay. So basically we are there across the entire chain, right?
We don't like, not for any reason, our risk appetite does not allow us to go for strategic for 2 reasons. One is that the yields are really very low for effort. And secondly, when there is an NPA, it becomes like a one big NPA of 10 crores and all. So we just don't think that is something that we want to do.
Okay, fine. Thank you.
Thank you. The next question is on the line of Jayan Kharote from JM Financial. Please go ahead.
Hi, this is Samir here. On the fee side, can you just explain what proportion or any broad guidance on what proportion would be third-party fees on distribution side?
I don't think we are disclosing that number except to the extent that is required in our annual report, which should come soon, I guess. But all I want to say is that just like our loan book, our fee book is granular. Almost every engine has started firing, whether you are talking about trade, FX, third party, that is, health insurance, bank assurance, MRTA, mutual funds, all these are helping us. Plus the ATM fees have started to build up. And part of the fee success also is because of processing fees. So we expect continue to do a good job on our analytics as well as the training of front end. We expect our fee income to do well. But I want to walk at least 3-4 more quarters before I say that, I think now fee income is something that we are confident of.
Okay, fair enough. Congrats and all the best.
Thanks.
Thank you. The last question from the line of Kaushal from Karvi Stock Broking. Please go ahead.
Hi, good evening, sir. Thanks for the opportunity.
No problem.
And congratulations on a good set of numbers.
Thank you.
Sir, we have actually seen a consistent improvement in net interest margins over the last few years.
Yes.
And thanks to the better mix in the cost of funds. So would like to understand, sir, in this present rate interest environment, what would be, sustainable net interest margins for us, at least for the next 1 to 2 years? Or would it be fair to assume even more improvement in the net interest margins, at least for the next 1 to 2 years? Hello? Hello?
Yes, for sure. Yeah.
Yes, sir. Hello?
Hello. Looks like Murli is dropped off. Yeah, Kaushal, can I answer that?
Yes, sir, yes.
The question is regarding net interest margin and what is our outlook to that.
Yes, sir.
What we have consistently said is, while we strive to keep best possible net interest margin, our model works if we are anywhere above 365, 375 basis points.
Okay.
At times, competition and market factors do have an impact on us because we are small and often we are price takers rather than price makers.
Yes, sir.
So, net interest margin anywhere above 375 is something which we are comfortable with.
Okay.
Sorry, Bharat, I got cut off.
Murli, I have answered his question.
Okay.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
So I would like to take this opportunity to thank you all for your support. We'll look forward to talking to you again next quarter. Thank you very much.
Thank you very much.